Hi there, this is Aubrey Chauke. I'm the founder of Chauke tutorials.co.za. Today we're going to have our session focused on depreciation. Depreciation is a topic that we normally deal with in grade 10 or 11 when we prepare an income statement. So this is just the basic foundation for you to be able to understand the things that you'll be expected to deal with. So I'm just going to be brief in this session because it is theory, and I'm going to try to explain at my level best for you to be able to understand. I'm going to talk to you about a number of things. I'm going to talk to you about depreciation. I'm going to teach you what is the meaning of depreciation. I'm going to put it for you in a way that you can understand, and I'm also going to show you how to calculate depreciation. I'm going to also show you the two methods that I used to be able to calculate depreciation. So you just need to pay attention and listen to this. Listen as you watch this session as much as you can so that you can understand. And should you have any question, please feel free to ask me. So the first thing that we need to be able to understand is that what is it that we are referring to when we talk about depreciation. Depreciation refers to the loss of value of an asset. I'm going to use a practical example for you to understand. Let's say, for example, today I buy a car and I drive each and every day to Mafikeng. By the end of the year, that car will have depreciated, will have lost value by a particular amount of value. Like, for example, normally in real life, I would say that a car that has traveled a lot of kilometers is no longer expensive. Like, for example, there are people who buy second-hand cars, and if you check the difference between second-hand cars and the ones that were owned before, is that the ones that were not owned before have got low kilometers. You can even find a car that has got 0 kilometers. So this means that this car has not depreciated. But then when you go to pre-owned cars, you will realize that some of them will have 200,000 kilometers, 100,000 kilometers. This means that that car has lost value by that amount of kilometers. That car has traveled those kind of kilometers. So when a person wants to buy that particular car, they will convert those kilometers that the car has traveled into a monetary value so that they can be able to know how much they should sell that particular vehicle to that person who wants to buy. So when you look at it, when you look at the depreciation, look at it into real life, that when you buy something, the more you use it, the more that thing declines in value. Like another example that I can give you is that of your cell phone. When you bought your phone at first, it was very fast. When you took pictures, you were very satisfied. But as time went on, as years went on, you realized that the quality of your lenses started to reduce in quality, and then also the speed of your phone started to reduce. So that is also depreciation. The more you use that particular asset that you have, the more it loses value. So in our curriculum, what they do most of the time, depreciation is calculated on vehicles, is calculated on they calculate it on vehicles, they calculate it on equipment, and then also furniture. But then the most rare ones are these two. These are the ones that they mostly focus on. So you need to be able to understand how to calculate this depreciation. But I'll get into this as we go on with our lessons. So for now, what I want you to understand is just to know what is it that we're talking about when we talk about depreciation. What are the two kinds of depreciation that are available, and how do we deal with each and every kind of depreciation that is available? So one thing that you also need to be aware of is that depreciation is calculated on a yearly basis. You calculate depreciation each and every year. As long as you have your vehicles, you have your equipment, you have your furniture. You have to find out each and every year the value that that particular asset depreciated by. You need to be able to find that depreciation for that particular asset. That's why if you check, when you prepare an income statement, you will have depreciation. What you're saying is that for this year, my assets have depreciated by this particular amount. So that's why I'm saying to you that depreciation is calculated on a yearly basis. If you check, when you calculate depreciation, you are working out of a period of 12 months. And when you convert 12 months into a year, you'll realize that a year is made out of 12 months. So that's why I'm saying depreciation is calculated on a yearly basis. And then one thing that you can also look at is that if you check, when you close off your depreciation account at the end of the day, when you do the closing transfers, you'll realize that you will transfer your depreciation amount to your statement of profit and loss, or to your trading account whenever you do those calculations. So you'll realize that your depreciation will reduce your income. The more you have expenses, the more your income goes down. So depreciation is a yearly expense, and for each and every year, if we're not using the fixed method, our depreciation will not be the same. So like you need to be aware of such things. And in each and every time when you buy a particular asset, they will tell you in what manner does that particular asset depreciate. Some, they will tell you that this asset is depreciated using the cost price, others using diminishing balance method, and so forth. But I will get into that in a short while. So for now, for you to be able to calculate depreciation, there are a number of things that you need to be able to have. First of all, you must know, it's a must. This is very important, especially like when you deal with the cost price method. It's very important for you to be able to know the cost price of that particular asset that you are calculating depreciation for. And another thing that is important is for you to know the rate of depreciation. This can be, sometimes they give you 10, 15 and 20%. These are the ones that I've mostly seen ever since I started doing accounting. So you also need to know the rate of depreciation. They will tell you, for example, that vehicles are depreciated at 10%, vehicles are depreciated at 15%, vehicles are depreciated at 20%. So you need to be able to know, you need to be able to identify the rate of depreciation. Another thing that you must be aware of is the financial period. You need to be able to know, when does our financial period start and when does our financial period end. This will help you to be able to know how long, it will help you to know how many months are you supposed to calculate depreciation for. For example, if we bought a car in January and our year ends on the 31st of December and we bought that car on the 1st of January, depreciation will be calculated for a period of 12 months. But if we bought that car in March, depreciation will be calculated at a different period. We will not use 12 months. We will only use the number of months that we've had that particular car, that particular equipment, or furniture with us. So you need to be able to be aware of the financial period so that you can be able to know the number of months that you're going to be calculating your depreciation for. And then the last thing that you also need to know is the number of months that you are calculating depreciation for. Remember, I mentioned this when I was talking about the financial period. You can just try to link this together. Once you're able to identify these things, it will be easy for you to be able to calculate depreciation. And another thing that you also need to know is that there are two methods of calculating depreciation. You need to be able to differentiate the difference between these two methods. I'm now going to talk to you about what is known to us as the cost price method. The cost price method is also known as a fixed method or straight line method. The reason why they're saying it's known as a fixed method, this is because you're calculating depreciation in a similar manner. As long as you still have that particular vehicle, you will be calculating depreciation on the cost price only. Like the cost price won't change, it will always be the same. The only difference will be the months that you're calculating depreciation for, because sometimes it can happen that you decide to sell that particular asset during the year, so the months will vary depending on whether you are buying or selling. And this is also, the method is also known as a straight line method. So when they are telling you to calculate depreciation, the first thing that you need to know is to assess, am I given the cost price method or am I given the diminishing balance method? For you to be able to know if it's a cost price method, they will either tell you that it's calculated on cost, it is calculated using a fixed method, or it's calculated using the straight line methods. They always play around these three weights, so you need to be able to know the interchanging weights that they use so that you don't get confused when you get that particular question. And then the other type of depreciation that you need to be aware of is known as the book value method, which is the worth of the car at that particular method. The difference between the book value method and the cost price method is that in terms of the book value, you need to be able to find out about the worth of that particular car or equipment or furniture that you are calculating for at that particular period. I will get into details about this as I explain the things that you need. And then you need to know the synonyms for these, for this method. This is known as the book value method or carrying value method. So you must know the interchanging weights that they use. If they say book value method or carrying value method, you must know that all the terms that they're telling you, they refer to the same thing. It's one thing. If they're saying book value, carrying value, you must know it's one method. And then you must know how this is differentiated from the cost price method. And for now, I'm going to show you the things that you will need to be able to calculate the depreciation on the fixed, straight line or cost method. I'm going to show you what you're exactly going to need or what you exactly need to look at. So now here they are telling us that to calculate depreciation on fixed, straight line or cost method, you need four things, which is true. You need these four things. The first thing that you need is the cost price on the method. Remember, we said that in terms of fixed, straight line or cost method, depreciation is calculated on cost. So it means that on the cost price method or on the fixed method or on the straight line method, you cannot calculate depreciation without using the cost price method. So the first thing that you want to do is to be able to find out what is the cost price of that particular asset that you are calculating depreciation for. So you need to be able to identify the cost price of the asset first. And then another thing that you will need is the depreciation rate. Remember when I was talking about that, they will tell you that it's calculated at 10%, 15%, and sometimes 20%. You need to be able to identify that rate. You need to be sure and know that this is the rate that they are calculating depreciation for. And then the next thing that you need to be aware of, as stated before, is the financial period. This is also known to you as the financial year. The reason why the financial period is important is because this will guide you to be able to know how many months are you supposed to calculate depreciation for. I hope this makes sense. The last thing that you will need to know is the number of months that you are supposed to calculate depreciation for. Is it 12 months? Is it 4 months? Is it 6 months or 1 month? You need to identify that. So now I'm going to take you through calculating depreciation using the cost price method, the fixed or straight line. So I'm going to show you an example based on that. I hope that after this you'll be able to understand what I'm referring to. So for now, we are given information from a business that is known as ABC Traders. So they're saying ABC Traders is a business that was established in 2018. So this business was started in 2018, and then they're telling us that the business sells furniture. So this business sells furniture to people. You can link it to the likes of Louis, the likes of Breadlows, the likes of OK Furnitures, and so forth. And they're saying that the financial year of ABC Traders starts on the 1st of January each year and ends on the month end of December. So it means it ends on the 31st of December. So the first thing that they gave us here is the financial period. Remember when I told you that when you calculate depreciation, one of the items that you will need is the financial period. If you check here, the financial period, it means it will start from the 1st of January to the month end of December. So this means our year starts on the 1st of January each year and ends on the 31st of December. Like, you know, when people back Haolangwa. I hope this makes sense. Now, on the information, we are told that on the 1st of May 2019, ABC Traders bought a delivery van costing 100,000 cash. So these people, they bought a delivery van. They bought a delivery van to be able to deliver the products to the customers. Remember, in the business, when you buy vehicles, your assets and so forth, you buy them so that they can help you in the running of the business. You buy them so that they can help you to be able to generate more cash. So this delivery van that was bought was costing 100,000 cash. Remember, when we were identifying those elements, I spoke something about the cost price of an asset. So for now, you know that this 100,000 is the cost price, right? We know that 100,000 is the cost price, and then they're saying this delivery that they bought is depreciated. The depreciation is calculated at 10% per annum. Remember that time when I was referring to about the depreciation rate, right? So now we know that on the information I will show you, I identified those things. We know that I just hope I have space somewhere to show you. I'll just use here so that we can be able to go back to those steps. Now we know that the year starts at the beginning of 1 January. Remember that particular delivery van that we bought, it was bought in 2019, so it means that we are operating during the 2019 financial year. So here's 1 January 2019 to 31st of December 2019, right? And then if you come here, I'm going to do a timeline for you to be able to understand how that depreciation was calculated. Remember, the year starts from the beginning of January to February. Then we have March, April, May, June, July, August, September, October, November, December. It's 12 months, so it's January, February. I'm going to show you January, February, March, April, May, June, July, August, September, October, November, December. So it's a period of 12 months. Even if you count here 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So it's 12 months, right? So we've already made the timeline. So what I'm going to do now is I'm going to change the color so that you can be able to see when I show the effects of that, the effects of the calculations. So remember, in terms of the steps, the first thing that we said we need is that you must identify we said you must identify the cost price, right? We spoke about the financial period. So if you check, remember at the bottom I showed you that the financial period is from 1 January to 31 December 2019, right? Which is what we have. And then let's go to the bottom and write what we have. So we know that the cost price here, the cost price is equals to 100,000, right? Then we need to get the bought date. When was it bought? We need to be able to identify that. They told us on the information. So they told us that it was bought on the they told us that they bought the delivery van on the 1st of May 2019. So it means you are calculating from 1 May to 31 December, right? So we're gonna go there. Let's check the rate before we go to the bottom. The rate, we know they told us the rate is 10%, which we identified, the cost price 100. So we're just going to go there and do the calculations. So we know that the cost price is 100,000, and then this thing was bought on the 1st of May 2019. The rate was 10%, right? And then if it's January, February, March, April, May, it means we bought it here. We bought it here on the 1st. So our depreciation, we're supposed to calculate from here until December. And then we know that our cost price is 100,000. So we're going to have 100,000 here. The next element that you're going to need to calculate is the number of months. So we're going to say multiply by those particular months that this thing has to be depreciated for. So it's from May, June, July, August, September, October, November, December. So it is 8/12. Then you multiply by 10/100 because the rate of depreciation is 10%. And then if you can also look, we know that our financial period, it's 8 months, right? It's 12 months. Our financial period is 12 months, and this thing was not with us for these 4 months. It was not available here. So it means we just, out of that 12 months, we just less 4 and we are left with 8 months. So if you take 100,000, then you will calculate. I'm also calculating on my calculator. 100,000 multiplied by 8/12 multiplied by 100. So we multiply by 10/100. We are getting 6,667. Remember, in accounting we round off to the nearest rand, so you're getting 6,667. So this is the depreciation that they want you to calculate. In your income statement, you will see this depreciation figure, right? So this is how you are supposed to calculate depreciation on the cost price method. And then remember, in some examples, they will give you the asset register and ask you to calculate depreciation for particular years, and you need to be able to do that. But then I will do that with you on our next session. So this is how you calculate depreciation on the cost price, right? So with this part, we are done with the first method, calculating depreciation on the cost price. I'm going to show you how they did it on the notes. So on the information, if you check, that's exactly what we did. If you move from here, if you calculate, that's May 1, 2, 3, 4, 5, 6, 7, 8. So it's 8 months as they've done. So you can also, since they're saying that the delivery van was bought on the 1st of May, it means it will start depreciating. The first month will be May because it was bought on the 1st, and then it will be with us for the entire month. So we would have to calculate that month of May. Now we're going to go to the second method of depreciation, which is known as the diminishing balance method. So I'm gonna take you through that method, which is known as depreciation on the book value. Depreciation on the book value can be book value, carrying value, also they can say diminishing balance. They like this one. It's either diminishing balance method or carrying value method, or even book value. They will play around this, so you need to know when exactly are you supposed to apply this method. Now the only difference between this one and the first method is that on the first method you only calculate on the cost, but then on the second method, where you have to, when you use diminishing balance method, you firstly need to be able to calculate, you need to identify your carrying value. You must know the cost price. You must know the accumulated depreciation for you to be able to get the carrying value first. Here you need to calculate the carrying value first before you calculate depreciation. And I'm going to use the information from the first example. I just changed names here and pretended as if it's a new company. So here they're saying I'm using my own business. They're saying Chauke Tutorials, it is a business that provides extra lessons for accounting students online. So this business of mine does virtual lessons. I provide online lessons with you being at home and me being at my place, and we conduct the lessons. So they're saying this business was established in 2019 by Aubrey Chauke, which is me. And they're saying the financial year of the business starts on the 1st of January yearly and ends on the 31st of December yearly. So now we have already identified the financial period, which is very important. It's very critical that we know the financial period. All right. And then, so this financial period is same as the one that we had on that example. Just that here, we are doing calculations for 2020, and this thing was bought in 2019. So here they're saying on the 1st of May 2019. So this is the date where that particular vehicle was bought. They're saying on the 1st of May 2019, Chauke Tutorials bought a vehicle for tutorials costing 100,000 cash. So the cost price has already been identified. As you can see here, we have already identified the cost price, and then the next thing that we need to be able to get, since we are using carrying value method, we need to be able to identify also what was the accumulated depreciation from last year. So they're saying the depreciation is calculated at 10% per annum using the diminishing balance method. As I stated before, that sometimes they can use the book value method. You know, it's the same thing. Book value, worth, carrying value, same thing. Diminishing balance method, same thing. So here they're saying calculate the depreciation on the vehicle for the year ending 31 December 2020. So it means our financial period starts from the 1st of January. So I'm going to show you how I calculated that. So unfortunately I will have to erase here because I don't have enough information. So I'm going to erase this part. I hope that you were taking the notes as you were watching this. I'm going to erase this part so that you can understand how those calculations were done. So should you have any question, remember that you have the responsibility to let me know where you don't understand, and you have to be honest also with yourself, you know. So remember I said the first thing that you need to be able to identify, you must identify. In this case we have to, if you check on the notes, I said that you need to be able to in terms of book value method, I said you need to be able to identify the cost price, you need to be able to identify the accumulated depreciation, the rate of depreciation, and the number of months in which the vehicle was with us as you calculate that depreciation. So now let's go to the information and check what is happening. So on the information, we're supposed to have opening balances for those accumulated depreciations and so forth. So here they're saying that the opening balance of the car that this business had on the 1st of January, it's remember this vehicle was bought in 2019, right? So we firstly need to calculate the depreciation for 2019 before we can get the depreciation for 2020. So I'm going to show you how they got this 667. So we know from the information they told us that the accumulated depreciation was 6,667. So like during the first year when they use diminishing balance method, they calculate that in the same manner as cost price, but the things change in the second year going forth, because remember by then you'll be having an accumulated depreciation. So firstly, let's calculate we need to look at the accumulated depreciation of the vehicle. So they said we bought it on the 1st of May, right? So it means it was with us from the 1st of May to the 31st of December. So if you check, it's May, June, July, August, September, October, November, December, right? And then, but we know that our financial year starts on it's January, February, March, April. So we know that this is where our year starts, 1 January 2019, and then this is 31 December 2019. So we firstly need to be able to calculate the depreciation for this first year when we bought this vehicle. We know that the cost price is 100,000, and then from the information we were told that the depreciation is 10%. So, and then the number of months, we know it's from May to December. So it's May, June, July, August, September, October, November, December, which is still 8 months. So it's multiplied by 8 over 12. What we're saying is that during the first year, we had this vehicle for 8 months. This vehicle was not with us for the 12 months that have passed. It means we bought this vehicle 4 months after opening operations. So you also know that the rate is 10 over 100 as shown on the information. So if you check here, the depreciation is the same as the one as when you calculate for cost price method. The only difference is when you go to the second year using the diminishing balance method. I hope this makes sense. So let's get the value of that depreciation. So it's 100,000 multiplied by 8 over 12 multiplied by 10 over 100. We're getting that 667 amount. So that's the depreciation for the first year. Now we have to come to the 2N year. The 2N year, that's where we will currently be when we close our books for that particular year. So if you check, they said we must calculate depreciation for the year ending 31 December 2020. So, and then if you check, we were not given any information about buying something. So I'm going to draw a timeline again so that you can understand. So if you check from January, February, March, April, May, June, July, August, September, October, November, and December, if you calculate the period, that's equals to 12 months. You can check it out. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So it's 12 months. So it means what we must do first with the diminishing balance method, what you must do first is to get the carrying value. So the carrying value is equals to cost price minus accumulated depreciation. So now we know that the cost price is 100,000. So the accumulated depreciation is that 667. That's the accumulated depreciation. So we need to less that 667. Remember, accumulated depreciation is a combination of depreciations, a combination of yearly depreciations. So we must get the carrying value. So 100,000 minus that 667 gives us 93,333. So it gives us this 93,333. So now depreciation in terms of the book value, carrying value, or diminishing balance method is calculated on the carrying value. So depreciation is calculated on the carrying value, and we know that the carrying value is equals to 93,333, right? And then we're going to take that so like we're going to take this 93,333, we're going to multiply it by 12 over 12, because remember there was no vehicle that was bought, there was no vehicle that was sold. So the vehicle that we had was with us for the entire 12 months, and then we're going to also multiply by 10 over 100 because the rate is 10%. So 93,333 multiply by 12 over 12 multiply by 10 over 100. It gives us 9,333. Remember, we round off to the nearest rand. So the depreciation for that would be that the depreciation using the diminishing balance method for this vehicle will be 9,333. That's the only difference. If you understand these things, you are almost close to mastering this topic. And then on the next session, I'm supposed to actually show you how this works in the ledger account and so forth. So you will need to, this one will be a paid session. I will show you how to, when you buy, how do you record that when you buy and when you sell. I'll show you how depreciation account is dealt with, how do they record depreciation, and then how also is accumulated depreciation recorded. And then I will also show you how to record in the asset disposal account when you are selling any asset that you had bought before. And then I'll also show you how this impacts the profit and loss statement. I hope that this lesson will be fruitful to you, and I hope that this lesson will also make sense to you. Remember that you have got the right to ask me questions where you don't understand. I wish you nothing but success with watching this tutorial, and I hope that this tutorial will be beneficial for you. Remember that our next session will be a paid up session. So God bless you. All the best.